Each business will have different, often conflicting considerations, not just financial, but commercial, growth and development, strategic. All these different considerations perhaps influence from internal, external shareholders, and all of these need to be considered when you're making an investment decision. That said, there's some great financial incentives currently available for businesses, and obviously in the current economic climate, that's very important. Okay, first slide here, business medium. Your current business medium is obviously important from a tax point of view because there are different rates and rules with regards to businesses. So unincorporated businesses, such as sole traders, partnerships, limited liability partnerships, they pay tax currently at a higher rate than corporate bodies. So we have 20%, 40%, currently 50% if your income's over and above 150,000. That's going to fall to 45% after April. And then we have companies. The main rate of corporation tax at the moment is 24%, falling to 23%, and then from 2014 to 21%. So obviously for smaller businesses, the potential is there to save, if they invest in electric vehicles, to save tax at higher rates. So for instance, if an individual had profits of over 150,000, we're currently paying tax at 50%. Investment in an electric vehicle with the capital allowances available would then send him down, would reduce his taxable profits and save him tax potentially at 50%. Corporate entities need to not only think about their corporate tax, but obviously if a car is made available to either a director or an employee for private use, then there is a benefit in kind issue. And electric vehicles then are very, very they're very, very good in this way because there's low benefit in kind rates at the moment. Financing options, so we'll need to look at the initial funding of the cars because from an accounting and a taxation perspective, that is very important. So my next slide will cover that in a little bit more detail. Tax incentives for the employer. So for electric vehicles at the moment, we have great tax incentives with regards to capital allowances, also savings in Class 1A national insurance. For the employee, there is the attractive low benefits in kind, nil benefits in kind at the moment. And then obviously we have grants which can reduce the costs of the purchase of the cars. Running costs, when we do look at purchasing any kind of car for accountancy or tax, we do look at the whole life cost of an asset. We don't just look at the monthly rentals that you pay. You need to look at that in conjunction with all your running costs. So we've heard various speakers here this morning saying how the fuel, insurance, maintenance costs should be lower. I believe there's less movable parts underneath the bonnet, so obviously that should hopefully reduce the maintenance costs. Cost of capital, so I think the next speaker is talking on residual values, which is obviously important from a tax point of view, an accounting point of view, and the time value of money. The final bit there on my slide, corporate social responsibility, your CSR policy, obviously not really a financial consideration, but it is very important because these days, obviously, clients, customers are very concerned that anybody they're purchasing goods from, investing with, etc., do take account of ethical considerations. Okay, so I said I would look at the financing options in a little bit more detail. Now, I'm not giving you an accountancy lecture in this, but it is important when you're actually purchasing your vehicle. The method by which you purchase it will have both an accounting influence and a tax influence. So the first three there, the outright purchase, the hire purchase and the finance lease, from an accounting point of view, their treatment is fairly similar. So basically they're recorded as an asset on your company's balance sheet and depreciated over the useful life. So the depreciation is an accounting adjustment for the wearing out of the asset. Then the liability will be shown, anything that is outstanding, any outstanding balances, liabilities on that asset, and the obligation to pay future rentals. So for hire purchase, we have an option to purchase usually at the end of an initial period. With a finance lease, typically we have a lease for a fixed period at a fixed amount, and that's normally followed by an indefinite period of lease, a peppercorn lease, which could be at a very small minimal amount. Those first three, as said, are treated very similar for accounting purposes. But the operating lease there is what we would call off-sheet balance finance. Okay, so with operating leases such as contract hire, the actual ownership of the asset isn't going to pass to the purchaser, so it's not shown as an asset on your balance sheet. We basically just apportion the rental payments under accounting practice, so you get a deduction through your profit and loss account. Tax treatment is obviously the important factor when it comes to this as well, because that's where your reliefs are available. So with the first two options there, you can see that you get capital allowances. Capital allowances write off basically the cost of an asset against your taxable profits. So if you had profits of 200,000 and invested 80,000 in electric cars, then you would have an £80,000 write-off against your profits, and that would save tax at your highest marginal rate. As well as that, if you have any interest element on your finance payments, that's allowed as a deduction in the profit and loss account. For a finance lease, you don't actually get capital allowances usually. So now it depends on the structuring of the actual lease, but generally, rather than get the actual capital allowances, the depreciation charge as worked out for accountancy purposes is your deduction each year. So obviously that would have a bit of an influence with you because capital allowances are coming off immediately, whereas depreciation is calculated over the life of an asset and will therefore be staged into the future. Operating leases then, you basically get the rentals are apportioned in accordance with generally accepted accounting practice, and they're deducted from your profit and loss account. At the moment, if your car emits CO2 emissions of 160 grams per kilometre or more, then there is a straight 15% add back for tax purposes in your tax computation. That again, the government is changing that, reducing it, and you now have the add back from 2013 if your CO2 emissions are more than 130 grams per kilometre. So the capital allowances, as I've said, this is really the most valuable relief as far as I can see at the moment with regards to the electric cars. We have a general capital allowances regime. You've probably all heard of the annual investment allowance. It's been in the press recently, and that's for the general purchase of plant and machinery. It's been increased from 25,000 to 250,000 with effect from 1st of January. But unfortunately, cars aren't usually, they're not included with that, the annual investment allowance. And usually for cars, you have very low rates of capital allowances. The whole regime for capital allowances is based on the CO2 emissions of the car. And on the left-hand side of the slide here, you can see up to the end of this tax year, March 2013, if a car emits CO2 emissions of less than or equal to 110 grams per kilometre, you get 100% first-year allowance. So that means the full cost of a car that you purchase will be written off against your taxable profits in that year. Going down, the CO2 emissions, in line with government policy, they're reducing that, so that relief will then, up until 2015, be restricted. A car will have to emit less than 95 grams of CO2. Obviously, electric vehicles emit nil, so they will qualify for that. You can see there that the more CO2 emissions your car does actually emit, then the allowances aren't as generous. So we have 18% per annum for cars in that middle main rate band, and then that falls to 8% per annum writing down allowances. So for your typical, where you would have had people with their Land Rovers, Range Rovers, etc., they now would not be a good option because it would take a long time to recover that from a tax point of view. Easiest probably just showing this with an example. So I have a car here. Purchase price 20,000 in year 1, and then that is sold in year 4 for £8,000. So if the CO2 emissions were less than 95 grams, basically in year 1 a full £20,000 would be deducted from your taxable profits. You would save tax at your highest marginal rate, so be that an individual, it could be 20, 40, 45, company at 24, 23%. And then you can see that for each of those examples, basically you get £12,000 of allowances, because that's what, the difference between the cost and your final sale value. But they're looking at that, there's an obvious, you get accelerated tax allowances if you choose the lower emissions car. And so that means you have enhanced cash flow. You immediately get that written off your tax bill. And as well as that, the main corporation tax rate is due to fall. It'll be 23% from April 2013. It's due to fall to 21% from April 2014. So you can see if you're writing it off in year one, you're getting the relief at a higher tax rate. And then when your proceeds of sale are coming into charge in year 4, you're being taxed at a lower tax rate. So I think that does work for individuals as well. The earlier you purchase these cars, the potentially higher rates of tax you will save. So benefits in kind, and this is for individuals then who are provided with a company car for private use by their employer. So the whole regime again is based on CO2 emissions and favours low emission cars. The tax charge at the minute is calculated on the list price of the car, so ignoring any discounts that may be given, it's the full list price of the car. And that is then calculated by a government percentage worked out by the government. Diesel cars have an additional 3% on them. So at the moment, if you had a car, you purchased it for 25,000. So for instance, if its CO2 emissions were in the mid 140 grams, then you could be looking at a benefit in kind of 35% of the list price, and that's annually. So that is a cash equivalent which is added then onto your salary, and you're taxed in that at your highest marginal rate. Now, bearing in mind for individuals, obviously with the tax changes at the moment, the rate coming into 2013 at which you're actually starting to pay higher rate tax is just over 41,500. So it doesn't take, whenever you add on the cash value of a car, add that onto a salary, it doesn't take long to push you into a higher tax bracket. Fuel benefit charge. So if fuel is provided for private use to an employee or a director and they don't reimburse it in full, then basically the percentage applies to whatever the government has as an annual multiplier. Again, that's best illustrated with an example here. So I've picked a car which actually, most cars these days do have, they're all trying to get the lower fuel emissions. So I've picked one which has 118 grams of CO2 per kilometre, list price of 30,000. So for that, the 30,070 is multiplied by the 18%, gives you an annual company car benefit of 5,413. Then the fuel benefit on top of that is 3,709. Okay, so you're adding just over 9,000 to your annual salary, and you will be taxed in that. So assuming most people with that kind of car are going to have a reasonable level of salary, they're going to be paying tax of at least 40% in that. That works out monthly tax of £304. If you contrast that then with electric cars, at the moment there is nil rate, zero benefits in kind with electric cars, and that has now been extended up until April 2015. So it's a good incentive for you for company cars for selling electrical vehicles to your employees, the fact that they won't actually be paying benefit in kind tax on it. It has been proposed, and I think it was December there, that basically these, after 2015, the rates for benefit in kind then will go up to 13% in April 2015 and 15%. And Quentin was just saying that he is going to be lobbying the government with regards to this, because obviously if an employee is used to paying nil benefit in kind tax, and then suddenly into their 3-year, 4-year ownership cycle of the car, they won't be happy, if their benefit in kind charge, although it's still low comparative to other vehicles, they wouldn't be happy with that increase. Zero fuel benefit as well, no tax charge where the employer allows their employees to recharge their cars at work for free. And again, an important saving here, Class 1A national insurance. If you have a fleet of cars, this certainly does mount up. When you do your annual P11Ds and you return to the revenue, basically you add together all the cash equivalent benefits in kind, and then you multiply that currently by 13.8% and pay that additional tax over to the revenue. If there's no benefit in kind, there's no Class 1A liability, so again, a significant saving. We do as well have these plug-in grants, 25% up to a maximum of £5,000 available at the minute. Now, although that will obviously, that does reduce your purchase cost from a business perspective, the employees don't actually benefit from that lower cost. Their benefit in kind is still calculated on the higher amount. So just touching on electric vans. Now, vans, unlike cars, are covered by that annual investment allowance I was talking about earlier. So we have that at the moment, 100% for investments of up to £250,000 pro rata from 1st of January. The van benefit charge at the minute, if you have a van and it's made available for private use, the employee then is charged £3,000 cash equivalent per annum. They may also have a private fuel charge on top of that. But for zero tailpipe vans, then that's reduced to nil. Those 100% allowances are also available on vans. And that's important. Although we have this annual investment allowance, if you're making a large-scale investment in vans, then it might not be covered by the full annual allowance, and these first-year allowances then can, mop up the relief and ensure you get the maximum tax relief on your purchases. Again, we have the grants for the vans, 20% up to a maximum of £8,000. So just basically a summary sheet of what I see as the financial incentives for businesses. So we have these enhanced capital allowances, and as I've said, extremely important for cash flows of businesses, especially under the current climate. No vehicle excise duty, no congestion charges, probably more relevant to the mainland than ourselves, but significant fuel cost savings. So fossil fuels have gone up something like 39% over the past 3 years. Obviously, electricity charges will rise, but with a much lower starting point. So, the fuel cost savings are still there. Plug-in vehicle grants available for those who are putting, plug-in stations at their workplaces or perhaps at their employees' homes. Lower benefits in kind to entice the employees who might not be so readily available to change their cars to electric cars. So I know that we can be sometimes hard to persuade here in Northern Ireland when it comes to accepting change, but the government fiscal policy is definitely supporting investment in green technology. And there's currently very favourable tax advantages, so hopefully we will see a lot more of these vehicles on our roads. Thank you. Thank you.